I'm starting with a daily chart of the NASDAQ Composite, and I just want to review some of the market price action over the past month or so. We had this follow-through day on January 31st, and after that happened, immediately that night I emailed all the members and said it is likely to fail. And why? Because first and foremost, there were no stocks setting up. What I mean by that is when I screen every night looking for strong fundamental growth companies building strong bases, they were pretty much non-existent at that time. Number two is we were still below the key moving averages. And number three is that the Fed is still hawkish. And what I mean by that is in the past, when we've seen V bottoms that just take us back to new highs, it's because the Fed is very accommodative. The opposite is going on right now, where the Fed hasn't even begun to start raising interest rates or their rate hiking cycle. So we just needed to be patient, and I was expecting most likely a move lower. And I even gave some comparisons to other potential double bottoms in recent videos. One example on the S&P was the beginning here of 2016, where we went lower and ran right into that 21-day and then ended up having a double bottom where we undercut that low. And that's kind of what I was expecting before potentially some sort of a move higher. The other example I gave was this double bottom in the NASDAQ where we had a leg down, rallied into the 50-day, again, where those key moving averages can sometimes be resistance, and then we had a flush down to undercut this low. Now, keep in mind, I'm not comparing these times economically. I'm just strictly comparing technically where we have a leg down, a normal counter trend rally where no stocks are setting up, and then I was expecting a move lower, at least some sort of a retest of the low. Now, going back to the current NASDAQ, I said after that follow-through day to still be defensive, to still keep things light, stick to a loss-cutting discipline, stay, with a decent heavy cash position just because I was expecting a move lower, and to basically stay defensive depending on your time frame and your investment objectives. And we ended up having a move lower. Now, some members emailed me and said thank you that they stayed defensive and it saved them some capital. Others said, hey, I know I should have stopped myself out, but I didn't stick to a loss-cutting discipline, and they got a little bit hurt during this leg down. If that happened to you, I just want to say keep your head up. We're always going to make mistakes. I make mistakes all the time. I'm just always doing post-analysis of my work and trying to keep those mistakes to a minimum. So if you did that, just learn from it. And the next time we start to see weaker market conditions, just learn to be a little bit more defensive. But keep your head up and stay strong. A lot of the things I discuss in the educational videos about mental toughness are very, very important right now, especially in higher volatility markets. Also, one other thing is some people are okay with higher volatility and have different risk tolerances and have longer-term time perspectives. And that's why I always say and encourage members to make these decisions on your own based on your own investment objectives. Now, let's move on to the big question of the day is, have we bottomed? Is this sort of a good retest? In other words, is this going to be sort of a classic 2 or 3 day short covering rally that maybe takes us back into that 21-day? Or have we bottomed and are we going to start to see a sustained uptrend from here? And of course, the direct answer is nobody knows. We have to continue to be patient and be defensive and let the market and a lot of stocks prove themselves. However, my instincts say that this won't be a sustainable low yet because, number one, same thing, I'm not finding a lot of stocks. I'll get into a bunch of stocks in a minute that are showing holding up well. There are some that are definitely improving but need time to continue to form their bases. But more importantly is it's hard to see a follow-through day, meaning when I reset the lines, this is day one of a new low. In other words, this was a day one of a new low when we had that previous follow-through day. But once you take out the low, you start to reset the count. So this is day one on Thursday, and Friday was day two. So now you need to see a follow-through day on days 4 through 10, which would mean the second half of next week or earlier the following week. And it's very hard for me to see institutions coming back into the market with serious conviction ahead of the March 16th Fed meeting. In other words, when I talked about some other examples, one example was this January 4th of 2019 follow-through day where the Fed Chair Powell says we're going to raise rates. They were raising rates in 2018, and he said we're going to raise rates another 3 or 4 times over the next year, and the market couldn't handle it. And then finally, on January 4th of 2019, was known as the Powell pivot, where he changed his stance from being hawkish to being dovish and saying we're going to be patient on raising rates. And that's what led to that follow-through day that day. Fast forward to another recent example. After we had the virus news hit in March of 2020, we had a follow-through day on April 2nd on the S&P 500 of 2020, and another follow-through day here for the NASDAQ on April 6th. And the reason we had this is because around these lows in March of 2020, late March, is where the Fed threw tons of bazookas, amazing accommodation that the world has never seen before. And that's what helped the institutions come back into the market. Now, it's not necessary to see the Fed change their tune to see a follow-through day. I just think before institutions want to come in with conviction, I'd like to see more stocks set up, and it'd be nice to see a little bit more clarity from the Fed. Maybe we'll get it after this March meeting. Maybe we'll get it later in the year, but it's hard to see that a lot of conviction being put into the market prior to the March 16th Fed meeting. So going back to the current market, what I'm going to do personally is I'm going to keep things light and continue to be open-minded, even though my instincts tell me that we're not going to see a sustained move from here. We might need to chop around. It doesn't mean we have to go lower, but I'm just going to be open-minded rather than, as they say, rather than predicting, just interpret the market, take this day by day, continue to screen. Things can turn around quickly. That's why it's always helpful to be open-minded and flexible when you approach the market, because things can turn quickly. And if I find more stocks and the institutions coming back in with some consistent volume showing that they're committed to this market, then I'll definitely increase exposure. But over the near term, I'm still going to be defensive until we get a clearer picture.